Moving Average, MA. Welcome to Ari Finance. In today's video, we are diving into one of the most fundamental tools in technical analysis, the moving average. If you've ever wondered how traders simplify complex price charts, the moving average is often their go-to tool for making sense of market trends. The moving average, commonly abbreviated as MA, is a trend-following indicator that smooths out price data by creating a single flowing line. It does this by averaging a specified number of past price points. This allows traders to focus on the overall direction of a market rather than getting distracted by short-term price fluctuations. Now, let's explore the different types of moving averages and how they're used. Types of moving averages. The two most commonly used types are the simple moving average, SMA, and the exponential moving average, EMA. Simple moving average, SMA. The SMA is the simplest form of moving average. It calculates the average price over a specific number of periods. For instance, a 10-day SMA will sum up the closing prices of the last 10 days and divide by 10 to provide a single value. The benefit of the SMA is its simplicity and reliability over long-term trends. However, it reacts slowly to price changes because it gives equal weight to all data points, which can be a disadvantage in rapidly changing markets. Exponential moving average, EMA. The EMA is similar to the SMA but places more emphasis on recent price data. This makes it more responsive to current market conditions. For traders looking to identify short-term opportunities or catch reversals earlier, the EMA is often preferred. For example, if a stock's price starts rising sharply, the EMA will follow the price more closely compared to the SMA, providing signals faster. How traders use moving averages. Moving averages are incredibly versatile and can be used in various ways. Identifying trends. One of the simplest ways to use a moving average is to determine the market's trend direction. If the price is above the moving average, the market is considered to be in an uptrend. Conversely, if the price is below the moving average, the market is in a downtrend. Support and resistance. Moving averages can also act as dynamic support and resistance levels. For instance, in an uptrend, the price may pull back to the moving average before continuing upward. Traders often use this behavior as an opportunity to enter the market. Moving average crossover strategy. This is one of the most popular strategies. It involves using two moving averages of different lengths. A common example is the 50-day SMA and the 200-day SMA. 1. When the shorter moving average, e.g., the 50-day SMA, crosses above the longer one, e.g., the 200-day SMA, it generates a buy signal. 2. When it crosses below, it creates a sell signal. Real-life example. Let's take a real-world example. Imagine you're analyzing the stock of a tech company. The price is trading above its 50-day SMA, indicating an uptrend. However, the price starts pulling back and touches the 50-day SMA without breaking below it. For many traders, this pullback represents an opportunity to buy, expecting the trend to continue upward. Now, if the price breaks below the 50-day SMA and stays there, it could signal a potential trend reversal, prompting traders to reevaluate their positions. Advantages and limitations. Moving averages are incredibly useful, but they're not without limitations. Advantages. 1. They simplify price action and make trends easier to identify. 2. They can be applied to any time frame, making them suitable for day traders, swing traders, and long-term investors. Limitations. 1. Moving averages are lagging indicators, meaning they react to past prices and may not respond quickly to sudden market changes. 2. In choppy or sideways markets, they can produce false signals, leading to losses if used without additional confirmation. Tips for using moving averages effectively. 1. Always use moving averages in combination with other indicators, such as the RSI or MACD, to confirm signals. 2. Adjust the period of the moving average based on your trading style. 2. Shorter periods work better for active traders, while longer periods suit long-term investors. 3. Practice in a demo account to understand how different settings affect performance before applying them in live markets. By mastering the moving average, you gain access to a powerful tool that can improve your ability to identify trends, time entries, and make informed decisions. In our upcoming videos, we will explore more advanced strategies and indicators, so stay tuned for deeper insights.